Hello, fellow Rebel Capitals. Hope you're well. Got a lot to talk about. Consumer sentiment survey. The University of Michigan just came out today, and consumer sentiment plummets right off a cliff. It was bad last month, but it is really, really bad. And what's really significant is the difference between Democrats and Republicans. You may say, oh, well, it's just those stupid Democrats, and they're worried about the Trump tariffs creating inflation, but it's more so across the board now. We'll get to that in just a moment. And the market's way up today, but it's what you'd expect in a potential bear market. And which states would or likely will be hit hardest by tariffs, or which states might benefit the most from tariffs, whichever way you want to look at it. We're going to dive into that right now. They're doing work in my office. That's why I'm in the whiteboard room today. You guys can see. You can see all my professional soundproofing with bed mattresses. they actually work really well. If you're starting a YouTube channel and you want to get some good audio, just go down and get some crap. Just go down to local Goodwill and just get a bunch of crappy bed mattresses and put them around, and it really helps out the echo. All right, let's get into it, guys. First, shooting over to CNBC. Then I might go over to the University of Michigan survey itself, but we'll start with CNBC. And Josh, do me a favor. Can you pull up my Twitter feed real quick and let me know when you've got it up? So topic right here, consumer sentiment. Slumps. That's an understatement. Consumer sentiment slumps. Okay. I think they're downplaying it here in this title, which is pretty rare because I would have thought they really would have gone all out with the title because you can blame it on Trump and you know how the mainstream media is. So sentiment slumps in March to lowest since 2022 as Trump tariffs spark more inflation worries. Yeah, but it's not so much about the inflation worries. And with this survey, it wasn't so much about Democrats versus Republicans. Like I was saying earlier, it's really about what's happening in the employment market. And oddly enough, you got to give credit where credit is due. This is what Snyder has been talking about like for the last 6 months, as far as seeing weakness in the labor market. Although the headline numbers look really, really good, when you look beneath the surface, it ain't so hot. But key talking points: University of Michigan survey of consumers for March posted a reading of 57.9. Get this, a 10.5% decline from February, and below the consensus for 63.2. Now, what's crazy, and this is why I want to go over to the Michigan survey itself, is if I am not mistaken, there was like a 10 or 12% decline in February from January. So if that's the case from January, we've got like a 20 or 25% decline in this survey. 1 year inflation outlook spiked to 4.9%, the highest reading since November 22. At the 5-year horizon, the outlook jumped to 3.9%, the highest since February of 1993. And this makes a lot of sense because everything that you're hearing in the mainstream media, because they're all or almost all very anti-Trump, is just how it's going to create inflation. It's going to create inflation. It's going to create inflation. Now, you guys know my view on this. I think it will increase some prices, and then it depends on how much he does tariffs or how much the tariffs are, right? If they're just 2.5%, well, it's not going to move the needle much. If they're 25%, okay, now we're talking. And then it also depends on the dollar. There's a lot of factors out there. These supply chains are incredibly, incredibly complex. So it's difficult to know what the knock-on effects are going to be when they're implemented, or if they're implemented, and to what degree. But let's just say that we do get some extreme ones, 25% or 200% on champagne or something like that. It is true that the price of that stuff will go up, but because we really don't have wages going up, the people are going to have to rob Peter to pay Paul. So if they want that stuff that's coming in from China that has a higher price, they're going to have to take away spending from something else. And you may say in the long run, and this may be a valid point, that, well, they're just going to take that spending and, with the prices that are going up with the stuff coming in from China, and they're just going to allocate it to all the stuff being made here in the United States. You know, the champagne's a great example of that, because champagne, if I'm not mistaken, it only comes from a very specific region in France, and outside of that, I think you can't really call it champagne. It's just like white sparkling wine or something like that. You guys probably know better than I do. So that's a great example of something that if the price goes up by 200% because of a tariff, it's not like you can just buy American Dom Perignon or something like that. I don't know that they make Cristal in Michigan. So although they probably drink a lot of it there, or at least show a lot of it in the rap videos that are filmed in Michigan. But anyway, that's a good example there. You can't, now in 10 years, they might make great champagne in the United States due to the Trump tariffs. I don't know, but they're not going to be able to make it in the next 6 months. So you're not going to have that option. So you just got to pay that higher price. And if you're someone that's at maybe a lower income group that's not buying champagne, but maybe buying something else at Target or Home Depot, again, you're going to have to pull that purchasing power away from something else. So although those prices go up, other prices come down, and it kind of, on net balance, it doesn't do much. All right. While the measure is prone to, here we go. While the measure is often prone to disparities between parties, survey officials said sentiment slumped across partisan lines, along with virtually all demographics. So Josh, do you have that my Twitter feed pulled up yet?
I'm pulling it up now. I'm having some internet difficulties.
Okay. All right, well, let's keep going here while Josh is pulling that up. Consumer sentiment took another hit in March as worries intensified over inflation, slumping stock market. I don't know why they don't point out the elephant in the room here, which is the labor market, for heaven's sakes. And then, of course, they've got to throw in, this is all about Trump. It's all about Trump. It's all about Trump.
I have your Twitter up.
Okay. Yeah, go to that last tweet. Can you pull that up? There we go. Okay, so click on that, Josh. Actually, go back. I'm sorry. There you go. I'll just read this. No, right there. The big news. There you go. The big news in the University of Michigan data was not inflation expectations. I'm trying to read this here. Look at what people are saying about the jobs market. Expected change in unemployment worst since the 2008 recession. In other words, the GFC. No one is asking for a raise in this environment. So when you look at this survey, and this may be an outlier, who knows? We got to look at all the data and see what comes in over the next couple of weeks. But if this is any indication as to what's happening underneath the surface of the labor market, I mean, this says a lot. Going all the way back to 2008 is the last time it was actually this bad. And that goes with Democrats and Republicans. And that's what's really interesting. That's what's very different about this survey. So let's get back to CNBC, see if they got any more insights. Many consumers cited the high level of uncertainty around policy and other economic factors, frequent gyrations in economic policies, very difficult for consumers to plan for the future. Yeah, I mean, I have a hard time with this. I totally get it. If you're an importer or you're a business or a bank or something like that, and that you're like, look, there's so much uncertainty. Or if you're an investor in the stock market and therefore you're trying to predict earnings and whatnot, this makes a lot of sense to me, that the frequent gyrations in economic policies, because let's be honest, you may love Trump and love tariffs and think it's the greatest thing since sliced bread, but you've got to admit that his approach is very, let's say, difficult to know it's very haphazard. It's very kind of bull in a china shop, and therefore, you have to admit it does create an immense amount of uncertainty. But my point is, does this really impact consumers? I highly doubt it. I mean, most of the normies I know that are just employees or own a small business or something like that. If I asked them, are you worried about tariffs? Or they probably don't even know what they are. And they probably like, tariffs? Yeah, I kind of heard about the news, but I don't understand what they are. So I would highly doubt many of them are making huge economic decisions based on what their Trump's economic policies. That I have a tough time buying that one. So expectations fell 10% for Republicans, 24% for Democrats, 12% for independents. Sentiment overall has fallen 22% since December. Oh, I got that one right. Well, it was pretty good math guessing on my end. I said between 20 and 25%. There you go, 22%. The inflation outlook contradicts reports earlier this week showing the consumer prices rose less. Also, too, the PPI, the producer price index, went down. Let's go over that because I was going to touch on that yesterday. It was kind of yesterday's news with Chris, and we kind of got sidetracked so much that I didn't really bring it up. We were talking more so about the CPI, but it's definitely worth noting. And let's go to the calendar here, then we'll get back to the Michigan survey. Right here, initial jobless claims pretty much on par with what was expected. But where are we? Oh, no, I'm frozen here. This week's major economic report. Okay, shoot, now we're on next week. I guess that's because the market is closed. This is really annoying. Let's see if I can pull up this week's report that they've already moved on from for some reason. No. Well, I know it right off the top of my head. Let's do this, actually. Just do PPI data and okay, so we also look at this. Actually, a negative on services for PPI, but I know the expectation was for an increase of 0.3%, and it was flat. It was flat. So a big miss there on the PPI. And like I said, the services component of it actually declined. So a decrease in prices for producer prices in terms of the services component of the overall number. So that's a big deal. That's a really big deal. And usually, if I'm not mistaken, this is kind of a leading indicator for the CPI. So I wanted to bring that up. And then let's get back to, actually now, guys, let's go to the Michigan survey. There we go. And here we go. So the change year over year is actually 27.1%. Current economic conditions down 23%. consumer expectations down 30%. Jeez. And then the month over month for consumer expectations down 15.3%. And then the 10.5 in consumer sentiment that we were referencing earlier. Wow. Just really, really big declines. Let's see how the market is responding. Let's go back here. And market up quite a bit today, but I'm not yet optimistic until I start seeing higher highs and higher lows. We've been discussing this recently. And so we get this big pop in the Dow, up 674 points today. And look at NASDAQ, up 2.61%. Big rebound. But let me show you what I'm referring to by using the NASDAQ chart. We've been referencing this on the last couple videos we've done. And okay, the internet's a little slow today. So this is an example of a severe downtrend in lower lows and lower highs. Now we could, okay, this could be the beginning of a trend reversal here. And why is that important? I'm not a big technical analysis guy, but I do know that most of the hedge fund guys I talk to, that this is what they look for. So they're not going to come in and quote unquote buy the dip until they see a trend reversal to where you see this line. If we drew a line from here kind of coming down, how it would break through that and go, let's say it breaks through 18,000 and comes down a little bit and then starts to go up again, then they're buying. But they're waiting for it to break through that line of resistance, if you will. And once it does, then you're going to see some big money, some big players come into the market. But like we were saying earlier, or in earlier videos this week, that trend change has got to come from the passive bid, and that means retail. So we'll have to see if they play ball, and this could be just profit taking from a lot of the short sellers. And that's why you usually, when you see a downtrend in the market, even though it takes the elevator down, it's still kind of a bumpy ride here. But we'll have to watch this really closely going into next week and see if we can get over that 18,000 and get a bit of a trend reversal. And I would become much more bullish over the short term if that's how it plays out. Now, I'm just talking about the stock market. I'm not necessarily talking about the economic data. And let's take a look at bonds, up 4 basis points. So remember, we're still inverted because Fed funds is at 4.33. So the 2-year Treasury yield at 4.32, yeah, it's getting close. But my guess is, once you kind of get up close to the 4.33 level, it's going to start trending down again. Let's look at a chart there and see what it looks like. Yeah. So very similar. And we'll have to see if, although keep in mind yields have an inverse relationship to the price. So it goes down. We'll have to see if it really goes above that 4.33 level. And if it does significantly, then maybe we're going to have another slight move up in yields. But that would not be my base case. I mean, when you have yields go from 4.8 all the way down to 4.18, that is a lot of buying. I mean, they're like overbought, if you will. And it makes sense that they kind of take a breather. Let's look at gold. I mean, that all-time highs, like we said yesterday, really an incredible move. And it's funny, Josh pointed out to me today that one of the model portfolios I have for Rebel Capital's Pro, and this is actually the conservative model portfolio, that is just gold and T-bills. And then Josh has just been rolling the T-bills for me once every 3 months or whatever it is. And it's up like, I don't know, 10 or 12%. And he thought it would be fun just to compare that to the NASDAQ over the last 12 months. So actually, now that I say that, I'm kind of curious. We'll get into gold in a second. I'm sure the NASDAQ has to be beating me on that portfolio. But it's not necessarily just that the NASDAQ's beating me. It's more so risk reward. It's more so the risk adjusted return. And with gold and T-bills, I mean, what's your downside on that versus Nvidia or the NASDAQ? So if we go back, let's do a 1 year chart. So 1 year we were, let's just say 16,000 for easy math. So it's up, let's say 16,000. So we're up 1,700 roughly. So 1,700. And I know you guys are probably like, George, get on with the video. But I'm actually really curious here. Just bear with me for a moment. So we've got, let's see. So it's up 1,700 divided by 1,600. Yeah. So, I mean, right around 1,700 divided by 16. Yeah, right around 10%. So risk adjusted, I'm taking the gold and T-bills all day long over a wildly overpriced NASDAQ. But we'll have to see how it plays out. I shouldn't sit here and toot my horn, because the next thing you know, I'm sure the NASDAQ is going to rip to like 25,000 in the next 2 weeks and leave me in the dust. All right, let's get back to gold. So, yeah, boy, getting close to 3,000, and the chart on silver probably looks even better. And this is the one thing that has me kind of second guessing a recession, because silver, Dr. Copper at 4.88. I mean, if that was really going down with gold, then the probabilities for me that we're right on the doorstep of a recession would be a lot higher. But you're going to have to pay close attention to Dr. Copper. Well, this isn't at an old. So the chart for gold actually looks better than the chart for silver if we're just comparing technicals. All right, now let's go over the states that will likely be most impacted by the tariffs. I thought this was an interesting article from Zero Hedge. So we know that, yes, okay, we've got a 25 or possibly a 25% tariff on Canada. It changes so quickly, I don't even know if it's been implemented, to be honest with you. But it affects different states disproportionately, right? It's not just right across the board. So I thought this was interesting nuance that Zero Hedge is adding to what's going on with Canada and Mexico. So right here, following Donald Trump's imposition of 25% tariffs on Canada, I think he's got just a lot of carve outs. So it's like 50% of them. But anyway, as well as retaliatory tariffs on Canada, and the trade across North American borders has suddenly become much more expensive. This map from Visual Capitalists, Nicolo Conte, shows how much different U.S. states' trade is impacted by these tariffs by visualizing each state's combined share of imports from Mexico and Canada. So, geez, look at Montana. Whoa, 93%. 93%. I mean, I know they're on the border, but look at that compared to Washington. Washington is on the border as well, and they're importing 20% from Canada and Mexico. All right, so if you live in Montana, I'm sorry to be the bearer of bad news, but you're going to see a lot of prices go up. Holy cow. Maine, 72%. What's the lowest? We've got New Jersey clocking in at 11. California, 16. Florida, 14. So those are obviously going to be the least impacted. And so, if only 14% of what you're importing comes from these Canada and Mexico, but then the next question, of course, becomes the China, the big elephant in the room. But, people would notice, and Hawaii is only 6%. So they would notice, but my goodness gracious, what a discrepancy between Florida and Montana. But then look at Texas, as you would imagine, on the Mexican border, pulling in almost 50% of their imports from Mexico and Canada. So it's really going to move the needle, assuming that it impacts a lot of the good. And see, this is probably total imports, but Trump has so many of these carve-outs that you really can't keep track of. I don't know, what percentage of the 49% of Texas's imports are actually impacted by the tariffs. I mean, who knows? But I think this does a great job in breaking down we can't assume that, it's just a 25% tariff, and therefore that's what's going to be the impact on the United States. You have to look at each state to determine who is really, really going to get the shaft here. And again, Montana, wow, 93%. Jeez. So Canada and Mexico made up 28% of U.S. goods imports overall in 2024, but some states have much higher and lower, as you would expect the northern and southern states. Okay, we get the whole breakdown. Montana's high import dependency almost entirely on Canada. No surprise there. But what does surprise me is the big difference between that and Washington. And then with Texas, okay, yeah, I get it. They're on the border of Mexico, but so is California. And California was only like 16%. So this just goes to show you that with these tariffs, again, you can like them or you can hate them, but you can't just kind of look at them from a 30,000-foot level if you want to understand what the knock-on effects will be. You've got to get into the nuance and get into the detail and include that in your analysis. So then you say, okay, I think the probabilities are going to be X, Y, and Z. And then you've got to figure out, of the imports that are coming in from these countries, which do the tariffs apply to, and which has Trump set aside carve-outs for. And then who knows? That could change weekly. It could change daily. This is definitely a moving target that we're going to have to stay on top of. Hopefully not, but most likely and definitely into the future. All right, guys, enjoy your weekend. As always, make sure that you're standing up for freedom, liberty, free market capitalism, and we'll see you on the next video.